Thank you, good morning. Thanks for coming. Thrilled to be here at NIPFP, so I appreciate the invitation. I'm bringing you today something that's really fresh out of the oven. If you want to say it in bakery terms, the World Economic Outlook, and also talk a little bit about what the global outlook means for India, of course, which is probably what is most relevant for you and also more interesting. But let me indulge just for a little bit, maybe 2 minutes in I don't want to say self-promotion, but in an explanation of what we actually do. Because the IMF is while most people have heard about it, I always find that not everybody is really sure what we do. So let me just spend 2 minutes about telling you about the IMF, and then we link it to the global outlook. So the IMF was created 70 years ago, and of course our main focus, our main mandate is to safeguard global economic and financial stability. So we focus on stability, not because stability itself has in any way value, but it is one of the condiments to prosperity across the world, and this is why we have in our founding charter enshrined this mandate. And we try to pursue this mandate essentially by completing 3 different functions. And the first function is the one we're most known for often, and because it makes the biggest headlines usually, and that's our lending. And so on the lending side, I just want you to know one thing, is the IMF is not a bank. Okay? We do not intermediate funds like a bank would do. We do not finance projects. What the IMF is really more is like a cooperative, an emergency fund. It's like members have come together, have put money aside, and that fund is available when a member is running into trouble, when the country is short of foreign currency. They can come to the IMF and they can take some of those resources temporarily out until they have resolved their problems and they have kind of remedied the external deficits that have led to the outflow of foreign currency and have accumulated more reserves. But this is temporary lending because we're an emergency fund. Our lending should be temporary, and this is why our lending often comes in the context, or normally comes in the context of a macroeconomic program. Because we want the countries to adjust their policies so they're able to pay back and they're able to stand on their own feet. Now for India, this is distant memory. The last time the IMF lent to India was in 1991. A big time for this country, really, when a large set of structural reforms were implemented. And at the time, the IMF partnered with the Indian government to support those reforms. Now, another activity we have is capacity building. We actually spend quite a bit of our resources, about a third, on training and government officials, and also on sending experts to work together with governments and central banks around the world to strengthen their capacity. We have now, a year ago, opened a fairly large training and technical assistance center here in New Delhi. It's called SARTAC, South Asian Regional Training and Technical Assistance Center. It covers 6 countries in the region, including India. And it has one particularity. It's the first in the world for 2 reasons. First, it does training and technical assistance at the same time, so we have both experts there. But second, this center also will cover, and is covering, states of India. Typically, the IMF engages with central governments, but in India we have states that are probably among our largest members if they were independent. So, and given the growing importance of the states, especially in controlling fiscal resources, we felt that, and the Indian government also felt that it would make sense for the IMF Center also to cover and train officials from the states, and so we have started that as well, and we're quite excited about that. Now, what we're going to talk about today comes from our third area of activity, and that we call surveillance. I would rather call it also providing policy advice. So this is a policy dialogue that we have with all our members. We have bilateral dialogue. We have all our members are required to periodically, usually every year, undergo an assessment by the IMF staff. It's called the Article 4 consultation. We issue a report where we kind of express our views on the economic situation, and we report on the policy dialogue we have with the government about the ongoing policies. We discuss, whether the current policy stance is adequate or whether there could be adjustments, make suggestions of changes, and those are typically put down in this report. The next Article 4 consultation will take place in May, and the next report will come out sometimes in July. So we have, of course, all these individual country reports and ongoing, but at the same time we also we care about the entire system. This brings us to something we call multilateral surveillance, and this is really where the World Economic Outlook comes in, that we will be discussing today. So at some point we take all these individual forecasts, put them together, and see do they make sense at a global level, and what trends we see at the global level. So there we discuss really issues of global financial stability and global economic stability, which is, as I said, part of our mandate. And the World Economic Outlook is a publication that comes out twice a year, in April and October, and it takes a quite comprehensive view of the global economy and its outlook, as the title says. So, with this little background, let's jump into action here. Let's talk about the global outlook. And let me give you maybe the big picture first, so you know what to look for when we go into the charts. So first, what we've seen is that global growth really has strengthened in 2017, and quite strongly. It's been marked by a rebound in global trade and recovery in investment, especially in advanced economies. And this has been the strongest pickup in growth and the highest growth level since 2011. Now, the outlook is that we're still going to have slightly higher growth in 2018 and 19, not much, but slightly higher at the global level. And the situation is that in advanced economies are growing a bit faster than their cruise speed or their potential rate, because they're still closing output gaps. Output gap means that the economy is not operating at full capacity yet. Remember that advanced economies were quite hit by the global crisis, so some of them are still catching up. But as we look further out, we'll see that the potential in the medium term is not as strong, and so this is a temporary spurt that will probably slow down in the outer years. In emerging markets and developing economies, we see a bit of a two-class society. The commodity exporters are struggling a little bit, have been recovering slightly because commodity prices have risen, but still the outlook is probably weaker than that of other commodity importing economies, especially in Asia. The risks, we always, sometimes we joke that the IMF is paid to worry, so we always worry about risks. We try to think what can go wrong. And the risks in the short term, we feel that this quite strong economy in the short term is relatively firm. So we think that the risks are balanced around our forecast in the short term, which means that there could be upside surprises or downside surprises, and probably as the probability of both happening is probably about the same. But we do see the risks in the medium term skewed to the downside. So there's probably a bigger risk that our medium-term forecast will fall short than that it will exceed what we are putting out there. Policy advice is a big part of our work, and there really the issue is that there's a window of opportunity to enact policies that, one, will boost the potential growth, and two, also allows countries to address some of the vulnerabilities. So when the next downturn comes, they'll be in a better position to respond. So we have been saying this for some time. I think earlier our managing director used the catchphrase, you fix the roof when the sun is shining, and I think that is basically still valid. So we always face a struggle in our policy advice to get countries to perform when times are good. When times are bad, sometimes it can be politically easier to do reforms, but it's also a worse time. And the good time is always when the economy is doing well. So this is a key message that we are putting out in our policy advice and in the World Economic Outlook. So let's look at some data. So what we saw is that clearly the growth momentum was very strong at the end of last year and even continues into the early 2018. Here you have a chart that shows you global trade and industrial production, and you can see that already last year really both the trade volumes and industrial production have been on an upward trend. That trend has been going on for a while, but has continued quite firmly. And much of this increase in trade volume and industrial production has been driven by a pickup in investment in advanced economies especially. And that is a welcome development because investment had been very depressed since the global crisis. And that was a big concern in terms of global activity.
So any specific reason for the dip in 2015?
No, I don't recall a specific reason, but what happened there in 2015, I would have to look. I don't recall anything specific, but the more general point is, trade has been quite cyclical, but has been rather weak across the board. So even all these small recoveries in trade have been suddenly compressing again. One of the things that's actually an interesting box in the World Economic Outlook as well, is that some of the trade patterns we see or trade cycles have been upended by technology cycles. So there's a box in there that tells us about trade cycles based on the release of certain cellular phones, for example. So when new models of certain IT products come out, there are global value chains that suddenly kick in and that start ramping up production beforehand. These have created a somewhat unsynchronized trade cycle. But I would have to look what happened there in 2015. I'm just thinking it could have been, although fuel prices fell later. So I have to look. Again, apart from that, some of the indicators that we look at that are slightly more forward-looking, like purchasing managers' indices or consumer confidence indicators, also tell us that both in advanced economies and in emerging markets, the sentiment has remained quite strong even through the first quarter of this year. So the global economy really is having a quite strong momentum at the moment, and that momentum is quite broad-based. If we look at inflation, inflation has finally shown some signs of life, but it remains generally subdued. As you will recall, in the past years, really our concern has been that inflation globally is too low, and especially in advanced economies. So it's hard for us to adjust to that, especially when we're in emerging market economies, but there's such a thing as too low inflation from an economic perspective. And for many years, inflation has remained below the target of central banks, especially in advanced economies. And now, more recently, inflation has picked up globally, mainly because also commodity prices have been rising. So the headline inflation, which is the blue line, we see is picking up. But also in advanced economies, we see a slight pickup in core inflation, which is inflation when you take out the volatile prices such as oil prices. And but it's still significantly below the target of central banks. Typically, they target about 2% rate for advanced economies, and you see there's still some way away. So overall, inflation remains subdued, but trending slightly upward, which is in fact what you would expect if economic growth is picking up globally. But it's been a very, very smooth or slow pickup that we see. So no big pressures here, but a little bit of life finally showing up. Now, global financial conditions have remained loose, and loose in this case means, of course, it's easier to get financing, which is positive for economic activity. We have had, of course, recently, you'll remember some volatility in equity markets. We had some volatility in February, and then we had quite a bit of a correction in March. But still, despite this, I would say generally the financing conditions have remained accommodative, have remained quite loose, especially by historical standards. And here I show you just a chart of inflows into emerging market funds. And you see that, especially last year, the inflows were quite consistent and strong in one direction. There was a big jump early in this year. And then in the last couple of months, these inflows have slowed again somewhat. But in general, what you'll see is that really there's been a long period of capital inflows, of investment inflows into emerging market assets. And that, of course, is positive. It keeps financing costs down for emerging markets. Now, against this background, let me shoot out our main growth projections here. So maybe we look first at 2017, how we did last year, and you'll see that world growth accelerated quite strongly from 3.2 to 3.8%. And 2/3 of the countries, of our member countries, which are 189, 2/3 accounting for about 3/4 of our output, experienced an acceleration of growth. In this slide, the green numbers means this is an acceleration compared to the previous year. The blue number means it's the same level, and the red numbers mean that the growth is slowing. So the one thing you can see in 2017, you see among advanced economies here, only green numbers. So it was a very broad-based recovery we've seen, strong and broad-based. You see among advanced economies, growth rose from 1.7 to 0.3%. And as I said, growth was higher almost across the board. The UK being maybe an exception due to, of course, internal issues, especially related to Brexit and the implications it had on confidence and investment. The United States growth, we see a big jump, very strong, and we also expect, if we now move to 2018, a big acceleration in the United States. In 2018, growth will rise from 1.5 in 2016 to 2.3 last year, and now 2.9 expected this year. And in good part, that reflects really the stimulus that is coming from a double the double impact of one, a big tax cut, and two, also a fairly expansionary budget. So in the short term, there's a big boost to demand. Now, being the United States an economy that is already at or close to potential, but this also will mean that this additional demand will spill over to other countries. So we expect the current account of the US to rise as well. But in the short term, we have here a strong expansion in the US. Now, this will later reverse because part of the stimulus is temporary. But in the short term, of course, that gives also a boost to global growth. Across the other countries, you see already from 2018 and then more in 2019, you see that some countries' growth is slowing, and that simply reflects the fact that countries have been growing somewhat more than what their underlying potential is. And each economy has a cruise speed that is, at least in the short term, fixed, and you can grow faster than that if you have spare capacity, but at some point, once you reach your capacity levels, then typically growth will start to slow, and this is what we see in 2019. And certainly also we expect this in the medium term to happen, and I will talk about this in a minute a bit more. For emerging markets, the growth projection, again, we saw a strong acceleration in 2017 across the emerging markets as well. There's one little outlier there that will be easy to spot, that is close to your heart, which is India. India in 2017, we expect growth to come out ultimately at 6.7%. So a little bit of a slowdown compared to 2016. And that, of course, is explained by purely domestic factors. We can talk about this a bit later on. But elsewhere, you saw also accelerations elsewhere, especially in China, strong, especially because there was quite substantial policy support, which means very, very expansionary credit policy. But also Brazil and Russia, which are commodity exporters, have finally emerged from their fairly deep recessions and quite strongly. If you look at the change in Brazil from minus 3.6 in 16 to 1%, that's a big change in direction. So this has helped push up emerging market growth. We see a bit more acceleration in the next couple of years, 4.9 in 2018 and 5.1 in 2019. And that will be driven mainly by other emerging market economies than China. In China, we expect to slow down as the economy is essentially converging to a lower but more balanced growth path. And I come back to that in a minute again. Now, while the short term looks really good and gives us a lot of comfort, I think the issue that we worry about is the medium-term outlook, which is less buoyant. And here you see just again an aggregate of global growth. You see that we have a pickup in 17, 18, 19, but then actually growth is leveling off, and in fact will be slowing a little bit. And if you also look at the average, kind of make an imaginary average of that, of those growth rates around 3.7, 3.8%, you see that these growth rates are certainly lower than some of the global growth rates we'd seen before the global crisis as well. And this has to do a lot actually with the slowdown that we predict for advanced economies. Advanced economies this year and last year have surprised on the upside, and part of that surprise was a cyclical rebound, and part was also some recovery in potential growth. But in general, the medium outlook for those countries is still one where productivity growth will be quite weak, and where especially demographic factors will weigh on their growth outlook. So many of the advanced economies are aging, and that means that the labor supply will slow, and therefore the potential, the capacity, the productive capacity of those countries is not growing as fast anymore as it used to. And this is what brings down our growth in the medium term. This chart here tells you where growth is coming from, what the growth contributions are. If you look at 2017, you see that, for example, that India and China together they make up about half of global growth currently. And if you look up to 2023, you'll see that the composition of growth will be changing. You see that the growth composition of China, which is the yellow part, and the growth contribution of advanced economies, which is blue, will be smaller. And of course, we're looking for other countries to step in, other emerging markets to step in and fill that growth void. And the one we're hoping for, rooting for, is the one as the red bar in this chart, which is of course India. So as India's economy continues to grow, it has, of course, it is gaining a higher weight in global output. It's becoming more important globally, and that means that its growth also is more important for global growth. It has a higher incidence, and so one of the things we will see over the next 5-6 years in the medium term is that the global growth engines will have to change. And that, I think, is a big challenge for our global economy. In China, let me talk about a few factors here that are important for our forecast. China is undergoing a big structural transition. It is moving from a growth that is driven mostly by export to growth that is driven more by consumption. And from a sectoral perspective, it's moving from growth that has been driven more by industrial sector toward services. And quite a bit of that transition has already happened, as you can see in this chart here. This is just the share of services and industry in GDP in China, and you see that the services share has been rising continuously, and the industrial share has been falling, especially in the last few years. So this process still has some way to go. If we look at the services shares of some other countries, some other emerging and advanced economies, they can be as high as 60 or up to 70%. So we think this process still has some way to go. But certainly the rebalancing, how we call it, the rebalancing of growth toward higher quality growth, that's driven by investment also, is certainly progressing. The main issue is that in this process, really debt levels have increased quite dramatically, and the challenge is really to try to delever, to reduce the pace of credit growth, and to address some of the issues that have emerged in terms of asset quality in the financial sector. The authorities are taking steps to tighten regulation, but this is a process that will take some time. Again, our baseline is one of a fairly smooth adjustment, but there is a risk of a more bumpy adjustment that could mean more volatility and maybe also a sharper slowdown in growth if that was to materialize. And again, as I said before, remember that China represents about 1/3 or so of global growth. So growth in China will continue to be very important for how the global economy is doing. The other issue that is, of course, important for our forecast is global financing conditions. I think our outlook is that financing conditions are likely to remain benign, but there are some risks of volatility down the road, and those risks have to do with the fact that globally, risk premia, both premia for inflation expectations and premia for credit risks, have been very compressed. There's been a lot of liquidity out there, and so the compensation that investors get for risk have fallen to very, very low levels. In some ways that's good, because it encourages risk-taking, that's what you want, but it also might encourage too much risk-taking, and especially financial risk. And there's a risk that these kind of very compressed term premia, these compressed risk premia, will suddenly reverse when market sentiment changes. Now again, so far I think what we've seen in the market has been quite positive, in the sense that in the United States the monetary policy cycle has changed. The Fed is already tightening monetary policy, and this has happened in a fairly smooth way so far. The changes have been, or the tightening has been well telegraphed, well communicated, so there have been no surprises to the market. But you see on the right side the policy rate expectations that the market has currently. And the dashed lines are from 6 months ago, and the solid lines are now. And you see that in all the major economies, really the expectations are for a very, very gradual increase in interest rates. So the market still thinks that it'll take a long time until really monetary conditions will be significantly tighter. Now, if there's a surprise, if suddenly there's an inflation surprise, if something unexpected happens that signals that central banks will have to tighten more aggressively, that could then mean that these very compressed risk premia can decompress very quickly. So there can be a retreat from risk, and that will create a lot of volatility in financial markets, and this volatility will also then affect capital flows, especially to emerging economies. Remember that investors have been pouring money into emerging economies because they're looking for risk, they're looking for higher returns, and that has been, of course, beneficial. But if suddenly investors become risk averse, if markets become volatile, then also some of these flows can go on. So there is a potential for financial market volatility and tightening financial conditions, and that is one of the risk factors that we see if we think about the outlook. A bit more formally here, you see the balance of risk. As I said before, we think the risks for our forecast are about balance in the near term. So there's some upside risk, some upside potential, really, which means that growth could turn out better than what we think in the short term. And that has especially to do with advanced economies having more slack, having kind of more capacity still to grow into. One of the things that we've seen is that unemployment rates have come down a lot, but wages have not risen. But it could be that we're underestimating really the potential that is there. One of the factors we see is that there are still quite a few people who are not unemployed but are employed work less hours than what they want. So there could be more slack, there could be more room still to grow, to expand employment, without wages to grow. If that was the case, growth could continue at a higher pace for some time. But then there are downside risks. I mentioned just financial conditions could tighten with the normalization of the interest rates in advanced economies. That's one of the downside risks. And one of the risks that we see, and that is currently being debated very strongly, if you looked at the newspapers today, the main discussion in the press conference of the World Economic Outlook was about the risk of trade action, and of course escalating trade actions across different countries, especially the major countries, that would of course affect economic activity. It will hurt consumers, but it will also have an impact on market sentiment and business confidence. So it could translate fairly quickly into a slowdown of the global economy if that was to happen. Our chief economist, Morris Obstfeld, he called it so far this trade war has been a phony war, and this refers to the phony war in Europe before actually war broke out, where people were sitting across the Rhine and were shouting, "Oh, we're coming," but they weren't coming yet. So at this point, of course, there is still time, and the IMF's call is to really use the multilateral fora to resolve trade disputes, to not act unilaterally. It's a big call from us. As we've said, in a trade war, there are no winners. Everybody loses. So that is a concern, of course. And as I said, there is still time, in our view, to address these issues. But if there was really an escalation of trade actions, then this could hurt our growth forecast and fairly quickly. There are some other downside risks. Some of them are really non-economic, especially geopolitical risks and so on. And one of the things, of course, that also happened is that some of these risks are interlinked. So if you have, say, escalating tariff actions, as it says here, it's not just hurting, actual trade volumes, and it's not just hurting consumers through higher prices, but it will also hurt market sentiment, and that could then spill over to financial markets. So we could see suddenly volatility in financial markets, and therefore a stronger slowdown, which then could really feed again more trade action, etc. So you can kind of see some spiral there that could happen in a negative outcome. Again, it's not our baseline, but these are risks to the outlook. Just here, the WEO has kind of some quantifications of this. On the left side, we calculate a probability of recession over the next 4 quarters, and the red dot is what the probability that we estimated in October, and the blue bar is probability now, and you see generally the probability now is lower than what it used to be in October. So and in general, probabilities of a recession next 4 quarters is fairly limited, by the way, especially in Asia. So in general, as I said, the short-term risks probably lower and well balanced. But there are some issues. You look at the right side as a geopolitical risk index, and you see that geopolitical risks remain quite high actually. So there is potential. These are risks, and they don't have to materialize. But still, we shouldn't get too complacent. About the outlook even in the short term. There are some factors that could pull down growth. As I mentioned at the beginning, we're all about policy advice, and our policy dialogue with countries is about policy advice. I don't want to go too much into detail because it's often very specific, country specific. It will surprise you when the IMF says not all countries are the same. We don't have a cookie cutter approach, and there are some common themes that we see in advanced economies. There's still the countries that still have output gaps in monetary policy will still have to be supportive. On the fiscal policy side, there are many countries that have accumulated a lot of debt, and if they have closed their output gaps, it's probably now time to start adjusting and to start reducing the debt. In structural reforms to boost potential growth are also probably across the board an issue that we recommend. On the emerging market side, I would say the cyclical positions are more divergent, and I mentioned before there's a difference especially between commodity exporters and commodity importers currently. Again, there is also room to improve potential growth, and in many countries, especially the commodity exporters, also the question of how to promote economic diversification is a big one, and this is something that policy should focus on. But also many of these countries actually have used up their buffers, and they need to build new buffers on the fiscal side or even on the foreign exchange side as well.